Myth number 1. If everyone is selling a stock, someone must be buying, so how can the price keep falling? Alex has been watching a stock fall for the past hour, down 30%, then 40%, with news breaking everywhere and the price dropping almost by the minute. Then he asks a question that sounds completely logical. If everyone is selling, someone must be buying, so who's on the other side? And why isn't their buying pushing the price back up? Every completed trade has a buyer on one side and a seller on the other. Alex is right about that, but the key word is completed. When a stock is crashing, sellers flood the market. Buyers exist, but they're not willing to buy at yesterday's price. They pull back their bids and only return at lower and lower levels. The seller doesn't choose the price. They have to accept whatever level the market will clear at. And when buyers only show up at lower and lower prices, the price falls. There's always a buyer. The price is just the level at which they're willing to be one. Verdict: true, but misleading. The confusion comes from thinking buyers stabilize prices. They do, but only at whatever price they're willing to accept, not at the price sellers want. Myth number 2. A stock that falls 90% is more likely to rebound. Alex spots a stock that was trading at $200 2 years ago. Today, it's at $20. He does the math. 90% down, 200 to 20. Surely, he thinks, it can't fall much more. How much lower could it realistically go? A lot lower, as it turns out. A company that has lost 90% of its value has usually lost it for a reason. The business is deteriorating. Revenue is falling. Debts are mounting. Something is wrong. The stock didn't fall from 200 to 20 randomly. Something caused it, and that something is often still happening. A stock at $20 that was once 200 can still fall to 2, another 90% drop from an already fallen position. From $2, it can fall to 20 cents. Each of those moves is still 90%. There's no floor that appears simply because the price has already fallen far. Verdict: false. A large prior decline tells you about the past, not the future. The company's actual financial situation, its business, its debts, its prospects, determines what happens next. Myth number 3. A $10 stock is cheaper than a $1,000 stock. Alex is looking at 2 stocks. One is priced at $10 per share, the other at $1,000. $10 sounds cheap, $1,000 sounds expensive. It feels like basic math, but it isn't. Share price alone tells you almost nothing. A company's stock price is just the price of one share, and how many shares exist determines the total value of the company. A $10 stock with 10 billion shares outstanding is worth $100 billion total. A $1,000 stock with only 100,000 shares outstanding is worth $100 million. The $10 stock belongs to a company 1,000 times larger than the $1,000 one. The affordable price was never the right measurement. What matters is what you're paying for the whole company, its revenues, its profits, its growth, compared to its total market value. A $10 stock can be massively overpriced. A $1,000 stock can be extraordinary value. Verdict: false. Share price without context means nothing. The right question is never, what does one share cost? It's, what am I paying for the whole business? Myth number 4. A company can have record profits and its stock can still crash. Alex is watching a company report the highest profits in its history. Record-breaking. $1 billion quarter. A CEO who's genuinely smiling. The numbers are extraordinary, and the stock falls 15%. Markets don't just react to what happened. They react to what happened compared to what was expected. If investors had already priced in even better results, if the market was expecting $2 billion in profit, and the company delivered 1.8, then 1.8 billion in record profits is still a disappointment. The same dynamic plays out with stocks. The price moves to reflect expectations, and when those expectations are already sky high, even a genuinely great result can fall short. This is sometimes called buying the rumor, selling the news. The price climbed while the market anticipated good results. When the results confirmed, but didn't exceed those expectations, buyers had nothing new to buy for. Verdict: true. Stock prices are built on expectations, not just results. Record profits can disappoint a market that already expected even more. Myth number 5. When a company splits its stock, your investment becomes more valuable. Alex holds 10 shares of a company worth $500 each. Total value, $5,000. The company announces a 2-for-1 stock split. Every share becomes 2, so his 10 shares will become 20. He feels richer. Nothing has actually changed. When a company splits its stock 2-for-1, two things happen at the same time. The number of shares doubles, and the price per share is cut in half. Alex's 10 shares at $500 become 20 shares at $250. 20 times 250 is still $5,000. Nothing about the company has changed. Not its revenues, its earnings, its assets, its debts, or what Alex owns as a percentage of the whole business. Companies split stocks for practical reasons, like making shares more accessible to smaller investors by lowering the per-share price. That can help demand, but the split itself doesn't create value from thin air. Verdict: false. A stock split increases the share count and reduces the price per share proportionally. Your total investment value stays exactly the same. Myth number 6. You can lose more than you invested in a stock. Alex buys 100 shares of a company at $50 each, $5,000 in. He tells himself what most new investors tell themselves. Worst case, the company goes to zero, and he loses $5,000. That's the maximum. For a regular stock purchase, he's right. If you own shares outright, what's called a long position, your maximum loss is exactly what you paid. If the company goes bankrupt and the shares become worthless, you lose your investment, but you don't owe anything beyond it. The downside is capped at zero. But certain strategies work very differently. Selling options without owning the underlying shares, known as writing uncovered or naked options, can expose an investor to losses that are theoretically unlimited. Short selling a stock works the same way. You borrow shares and sell them, hoping to buy them back at a lower price. But a stock can only fall to zero, while it can rise indefinitely. If Alex shorts a stock at $50 and it rises to $100, he owes the difference. If it reaches $200, he owes more still. Verdict: true, with a catch. For standard stock ownership, your loss is capped at what you invested, but more advanced strategies, short positions, uncovered options, can expose investors to losses beyond their initial amount. The catch matters more than most beginners realize. Myth number 7. A stock's price can fall even when nobody actually sells their shares. Alex goes to sleep with his stock at $52. He wakes up and it's at $47. He didn't sell a single share. He didn't do anything, and he's genuinely confused. If he didn't sell and none of his friends sold, how did the price fall? Stock prices don't require an actual sale to move. They're determined by the order book, a live list of what buyers are willing to pay and what sellers are willing to accept. The price on screen at any moment reflects the most recent transaction, but the displayed price updates continuously as bids and asks shift. If the buyers willing to pay $52 pull their bids because of news, a change in sentiment, anything, the next best offer might be at $50, then $47. The market price adjusts downward without a single completed trade at the new level. Nobody sold, but the price at which the next sale would happen, the current quoted price, changed. Verdict: true. The market price can change without any shares changing hands. Prices reflect the best available bids and offers at any given moment, not just completed transactions. Myth number 8. A stock that has been rising for years is safer than one that just started rising. Alex is deciding between two investments. One stock has climbed steadily for 5 years, consistent and reliable. Its chart like a well-behaved upward line. This one, he thinks, is proven. The other just started rising 3 months ago. Unknown, unproven, risky feeling. Alex puts his money in the 5-year climber. 6 months later, it crashes 40%. A rising stock price tells you what has happened, not what will happen. Beyond that, a stock that has risen for 5 years has often already priced in most of its good news. The market has recognized the business is strong, and investors have already paid a significant premium for it. What makes a stock safe or risky has nothing to do with how long the price has been going up. It depends on the business itself, its finances, its competitive position, its debt levels, and crucially, what the current price is already assuming about the future. A company priced for perfection after 5 years of gains has no room for error. One missed quarter, one unexpected competitor, one stretch of bad news, and the price corrects sharply. A newer rising stock with solid fundamentals and a reasonable valuation may carry far less real risk than it appears. Verdict: false. Past price performance isn't a measure of safety. Risk depends on the business, the current valuation, and what the market already expects, not how long the price has been rising.